Welcome to another episode of Investing with IBD Podcast. It's Justin Nielsen here, your host, and it is Wednesday, March 20th, 2024. We had another Fed meeting, so we'll be talking a little bit about that. And joining me, as he always does, is Arusha Paris. He's a portfolio manager and analyst over at O'Neill Global Advisors. How are you doing, Arusha?
I'm doing well, Justin. Another exciting day in the markets, huh?
Another exciting day. Yes, there's going to be a lot to talk about, and what Jerome Powell had to say, and more importantly, how investors took it. And to help us out with that, I should have said Arusha Paris CMT, because you do have those special letters behind your name because you have that chartered market technician designation. And
we're gonna have to have David on a number of times now because you never say it before. But when David comes on,
I did when Jay Woods was on. I made reference to it.
Okay,
but then I said I'm not saying it for you because I don't want to give you the extra kudos. But yes, I am going to start getting letter envy, I guess. Is that a thing? Because we have David Keller, CMT, coming back on the show. Of course, this is the chief market strategist at stockcharts.com, and he has that CMT designation as well. How you doing, David?
I'm good. Good to see you guys again.
Good to see you too. We both went a little clean shaven because usually you have a little bit of scruff yourself, and I
don't know if that's a sign of a market top or not, but we both have changed. That there's volatility on the facial hair.
Exactly. I guess, right? Well, we're going to be talking about some of the things like when we see divergences in certain signals. So I guess maybe this is a convergence that we did. So yeah, we can get into that a little bit, but we're going to talk a little bit about, again, these divergences that we're seeing in the market and what that could potentially mean for sector rotation. But before we get into that, let's talk a little bit about this Fed meeting. So we didn't get a cut. No one was expecting a cut. I think, the Fed futures before the meeting was like 99% no cut, 1% for a quarter cut. So, in the words of Jim Carrey, so you're saying there was a chance, but not really. So no one was expecting a cut. But in your mind, what was it about this meeting, or I guess the announcement that kind of sent the market higher and in a pretty strong way?
Yeah, I mean, I think you're right. I think it's sort of a foregone conclusion. There wouldn't be any change to the specific target rate today, but it was all about sort of the dot plot, right? And the expectations about future rate cuts. And I think the things that investors are looking at are, when the first cut is going to happen, and how many of them we're going to get in 2024, starting to look forward to 2025 and beyond, just sort of that pace, what that sort of glide path might look like. And to be honest with you, I don't think we learned anything particularly new, but what we definitely didn't hear was any sign that it was going to be dramatically more negative than what you would have expected, right? You didn't get any sort of negative shock that would have been rates higher for longer. Oh no, there's a chance we might hike rates again. And there's all sorts of things that I'm sure Powell could have said to communicate that they were, a little more concerned about inflation. But a lot of his language about how inflation is still kind of coming down as they would expect. They're committed to continue to keep things going in that direction, getting to that 2% bogey. But overall, sort of gives, I think more and more, we're getting some clarity on what that glide path would look like through the remainder of this year. And you're sort of seeing this way out of the Fed, the rate hiking period, and then the stabilization period, and then what a lowering in rates might sort of look like. So the market obviously taking that to as a positive influence. Stocks higher, gold higher, Bitcoin higher, all after that meeting.
You name it, it was higher, right? And I particularly thought it was interesting, again, the fact that the number three was kind of consistently, stuck to in terms of for this year. I'm sure, as you said, people were maybe a little bit scared with the latest CPI report being a little bit hotter than expected. Okay, could that maybe say, give some uncertainty there? But yeah, it's the fact that, we're sticking with three. And I think it was also interesting that he acknowledged that there's two risks here, right? If we start cutting too early, there's the risk of inflation coming back, which that's always been the boogeyman out there. But he also acknowledged that other risk of, if we leave it too tight for too long, we really risk doing damage to the economy, the labor market, unemployment, and all of those other things, that other side of the mandate, right? What are your thoughts on that?
If you think about I talk about a job I would certainly never have and never would wish on people like you as well. I mean, that's a tough gig. I mean, he's trying to, in a lot of ways, what the Fed is trying to do by, keep inflation in check, but also, basically go to full employment. I mean, at times those are sort of not complementary things they're trying to do. So I think it's a challenging road no matter what. I mean, I would say one of the biggest takeaways we haven't mentioned is just you kept reinforcing this, being data dependent. And what that essentially means in my book is every one of those additional readings we might get, like the next CPI, the next PPI, I would be laser focused on what that number might come out as, because any sort of surprise to the upside or downside, you're certainly going to see the market react, because that's the information they're looking at to sort of, think about those rate cuts. So I think you're right. They're very clear on sort of 3 looks like the right pace through the course of this year, but I don't think they would be afraid to change that if the evidence changes. So good reminder for me. I mean, I'm a chart guy, so I'm focusing on the evidence of the markets anyways. It's a good reminder to just stay focused on that economic data. It's going to continue to be important here in the coming months.
Yeah. So David, I'm going off of that. I haven't necessarily figured out a great way, but how do you use the information that comes out for the Fed? Usually I'm just kind of like what you were just alluding to there. I'm using the charts. I'm looking at the reactions to the, and then I'm aware of what they're kind of saying, but I'm really letting the stocks and the market and the price and volume action really kind of dictate my decisions. How do you generally incorporate, I guess, this Fed information that's coming out, and of course all the analysis that's coming out now too on what they said?
No, it's a really good question, Arusha. I mean, as a technical analyst, I'm very much biased toward the value of looking at price action primarily. And one of my mentors, Ralph Akinpur, would say, if you know nothing else about what's happening around you, have a daily chart of the S&P 500 and look at it regularly. And that'll tell you a lot of what you need to know. So what's interesting is when you look at the charts leading into this Fed announcement, just the initial reaction, I would argue the remainder of this week obviously going to be pretty important as well, because a lot of times you've seen an initial bounce after the Fed meeting or even during the Fed press conference, and then something totally different happens Thursday, Friday through the remainder of this week. So I think, I don't think the meal is done. We've kind of taken the big main course, and let's see what happens through the remainder of the meal. But I think looking at the evidence that the chart tells you, it's a lot like an individual stock with earnings, right? We can make assumptions about what a company's ability to beat earnings expectations and how those expectations might need to be tempered going forward. But at the end of the day, a lot of times it's a surprise when the company comes out a little stronger or weaker than expected. So I found looking at charts going into an earnings announcement to see what the market is pricing in, what sort of anticipation you're seeing, and then what sort of surprise afterwards. And I think a lot of times when you see a gap on an individual stock, it's what happens immediately after that gap that is so important, because that tells you, all right, we gap higher, are additional buyers coming in and sort of buying into this as not just a short-term win, but like a long-term thesis. That's why I think today the S&P closing above 5,200 for the first time, pretty monumental. I would say what happens the day after a Fed meeting, we've got some earnings like Nike and others, but through the remainder of this weekend to next, you see additional buyers coming in willing to push these prices even higher. I think that's the real question now.
Mm-hmm. And it's interesting that you mention that, because a lot of times we have been seeing, especially with the Fed meetings, the reaction, the counter reaction sometimes during the press conference, and then the counter reaction the next day sometimes. So, to your point, it's like you have the main course, and then, you have dessert, and you're allergic to bananas or something like that. So it's a little bit tough sometimes. But you also mentioned, and I like where you're going with this, earnings, because earnings are a binary event. You kind of don't necessarily know what's going to happen ahead of time, but a lot of times you have charts sometimes setting up, sometimes moving ahead of these events. And it looked to me like there were a few setups, ahead of this Fed meeting, but before the Fed announcement came out, you saw volume tracking very light, about half what it normally would on a few hours into the session. No one really wanted to step in front of that Fed train. So as a chartist, when the chart is saying, oh, this is looking interesting, but you've got this event coming up, how do you kind of reconcile those?
Yeah, that's a really tough one, Justin. And to be honest with you, a lot of times it's sort of like you want to pick the penny off the train track, right? I mean, is it worth that in this sort of environment when something so big is coming at you? Here's the way I would think of it. I like to think of charts, generally speaking, as innocent until proven guilty, or guilty until proven innocent, right? The market up until now, I would argue, while we can talk about some divergences, talk about some conditions that have certainly, raised a bit of a question mark, particularly with leading growth stocks, overall, the S&P is still making higher highs and higher lows. The NASDAQ 100 is still making higher highs and higher lows. The breadth conditions remain fairly strong. And that hasn't changed here in the last couple of weeks. Overall, it's been the story. So I think of a market like this as innocent until proven guilty, right? You assume that that trend is going to continue until you see enough evidence that it changes. And that could be a Fed event, that could be a big news event, that could be just the general rotation where investors, start to take profits, and where all of a sudden things run for so long that you start to get a meaningful drawdown. But the good news, again, from my perspective, is the charts usually have a pretty good way of telling you when something looks a certain way and then something's different, what I like to call a change of character. And I think for now, what you saw after the Fed is sort of just reinforcing the fact that, it's still sort of a risk-on environment. You always want to think about what a downside scenario would look like, but I don't think we're seeing any of that sort of follow through just yet. So I would assume that a trend persists until proven otherwise.
Yeah, so I'm pulling up the market surge charts here, and I have I'm showing and it should be showing pretty soon here, but I'm showing the S&P on the weekly chart, and when I look at it, and I don't want to jinx it, I just want to say this, but
it's on you if something.
I know,
exactly.
That's your problem. Okay,
but this is like almost picture perfect action here. It just keeps slowly crawling up, especially. I'm more used to it looking at just on individual stocks. When you see this kind of crawling up action and just slow accumulation there, that's exactly what you want to see in an individual stock. And I'm kind of seeing that in just these in the S&P 500 weekly chart here. Yeah. It just keeps slowly crawling up. It keeps being that lockout rally, and everyone who's been waiting for the pullback, these pullbacks come, but they're like only 1 or 2 days, and then they're back up to new highs. So it's almost the kind of the classic lockout rally where it continues to climb that wall of worry.
Well, and to that point, I mean, you've got a lot of weeks, a lot of blue weeks here, right? Very few red weeks. And if you go to the daily, this has been pretty much holding the 21-day moving average line. Forget about that 50-day moving average line that, people used to use. That's the 21-day is the new 50-day. I mean, it's almost, I guess what some people are afraid of, is this too good?
It's interesting. And when you think about either of these charts, I mean, there's a lot of similarities what we're seeing now in, end of first quarter of 24 versus like a mid 2021. No, obviously different environment, different style, but you had a fairly consistent uptrend. You had very few drawdowns. I mean, I think in 2021, 3 to 5% is probably the worst drawdown you had. VIX remained very low, right? You had a low volatility, sort of this slow grind higher. It's really just an accumulation phase, the best word I would use to describe it. And you're seeing a lot of similarities, right? Where it's just sort of a, no big pullbacks. You are seeing it on an individual stock level, right? Like a Tesla or something like that. But on average, benchmarks remain really strong. I would say the question mark with this particular environment is the other similarity is you have really narrow leadership. And I think that started to change because you're seeing a lot of other sectors, a lot of other stocks start to improve now. But up until now, right, sort of like January, February, it's a lot of the mega cap growth names sort of getting it done. And those are the biggest weights in the S&P. So when you're looking at the S&P, you're looking at 10 companies are a big bulk of that index right now. Same with the Nasdaq; it's even more concentrated. But undeniably, Arusha, you're spot on. I mean, low volatility, nice grind higher. That's the kind of thing I think you turn into a trend follower. If you're not a trend follower, right? Hopefully, a market like this convinces you to do so. Make sure that you continue to lock in those gains and bump stops higher. That's a really good way to approach it.
Mm-hmm. Well, and to that point, we're going to show one of the charts that you brought, the S&P 500 here, and you have the S&P 500, the percent of stocks above the 200-day, which on your chart shows 81.4, and then the percent of stocks above 50-day moving average, which is at 78.4. This is historically pretty
it's not
pretty high.
That is true. Yeah, undeniably, right? And so this is one of those classic measures of market breadth. And I think, to your point, Arusha, right, it feels like the market's in this slow, steady grind. I think the danger with a market like this, and what often happens at a major market top, is you'll see the index keep going higher, but the breadth conditions start to really weaken. Yeah, and that usually happens at the end of the move. That's sort of when everyone's kind of getting defensive, sort of putting on, taking risk off. You're kind of sticking with the Microsoft types of names that you're pretty sure are going to survive any sort of pullback. And then you just ride things out. That's what an institutional investor would probably want to do, or just get super defensive. You're not seeing that, right? The fact that, 8 out of every 10 S&P stocks above its 200-day moving average, just like the S&P is, that's pretty constructive. The fact that 80% are above their 50-day means very few have had a significant drawdown and are breaking below that, sort of basic, sort of short-term level of support. So as long as these indicators remain in this level, it tells you there's much ado about nothing in terms of worrying about a market deterioration. On this chart in particular, by the way, if you look about 2/3 of the way through in August of 23, that's what a meaningful pullback starts to look like. And that bottom panel shows you the percent of stocks above their 50-day went from around 90% to below 50% in about 3 weeks. That's what happens when a market really starts to get weakened underneath the hood, right? A lot of individual names are breaking below their 50-day. You can see right now we're not getting any of that sort of deterioration. As a matter of fact, I think 19% of the S&P made a new 52-week high here on Fed Day. So overall, the breadth is actually quite strong. And that's not about the mega cap growth names. That's about kind of everything. That's steel companies and copper companies and a lot of banks and other things that are actually going up as well. I think that's a pretty bullish tell at this point.
Well, and it's kind of similar to when you're looking at an individual stock and you're looking at any oscillator oversold, overbought. And there are times, a lot of times when stocks hit overbought, you're like, okay, let me lighten up, let me get out of it because it's going to pull back. But when you're in a really strong stock at a beginning of the move, it can be overbought and just be pinned overbought. And the analysis is almost the kind of the conclusion is almost different at that point. It's so strong, they just pin it there. And it just keeps going. And it's a positive instead of a negative or a slight, warning sign.
Yeah, we always call that the good overbought, right? It's sort of, and I think that's where you need to, and a lot of people just getting started, I think, try to oversimplify and just think, okay, overbought's bad, oversold is good, and just try to play like a swing trader. On the time frames you and I are paying attention, a little more medium term, a little more longer term, a stock being overbought is actually a very good thing. That means the price is going up, which I think is what we kind of want, right? So, particularly those big base breakouts, like a cup and handle pattern, you're really resolving, you'll often get an early overbought reading. And that's actually a really good thing. That tells you new buyers are coming in. There's a reset of expectations and more of a bullish sentiment to it. So I would agree. Breadth conditions sort of getting strong, in this case, often support further upside.
Mm-hmm. Now, is there ever a level, because I think it's interesting when you brought up the S&P 500 and the downside where, I mean, back in October of 2023, it got down to what, 10, in terms of number of stocks above their 10% above the 50-day moving average line. And that was ridiculously low. But are there ever worrisome levels where, this is kind of maybe too high that you start getting concerned?
Yeah, so I've highlighted on the chart sort of that pink shaded area is when that indicator percent above their 50-day gets up to around 90%. That has often been sort of a worrisome level. And you saw that, July of 23, right, just before that drawdown going into the October low last year. Further left, you can see a couple times, end of 22, summer 22. You find those times when, so many stocks are going up. It's almost a contrarian sell signal because we're almost too bullishly aligned. What's really interesting is the last time that happened was at the end of last year, December into January. It did not play out as expected. You really didn't get any pullback. And I would say that's because what happened was that was sort of that real initiation of all of those non-growth stocks all of a sudden starting to come to the party, right? Coming off the October low, it was like all growth. So breadth was not particularly strong, even though the markets were going higher. I think those are the leadership names, the Magnificent Seven sort of going. Now we've all of a sudden seen additional participation, which has actually been a little more positive. So at this point, I think revisiting that 90% level, that would cause me to think, at least in the short term, probably set you up for a bit of a pullback. That in general has been a good way that I've used this sort of indicator. But again, as a medium-term, long-term gauge, most stocks above their 200-day, that's a long way away for the S&P. That's another 600 points below today's close. So most stocks, in terms of the long-term trend, pretty constructive here.
Mm-hmm. It's interesting that you bring up that December time period because the Russell 2000 had such a strong initial move, and then it was like, it stopped participating. So it kind of coincided with that that big drawdown. Again, didn't happen in the NASDAQ Composite or S&P 500, but you definitely saw that weakness in the Russell and in a lot of individual stocks if you weren't in the Magnificent Seven, so-called. So when we come back, we're going to talk a little bit about this whole idea of sector rotation. And, when the market is so strong, Should you be continuing to look at the current leaders or look elsewhere? Stay tuned. We'll be right back. Welcome back to Investing with IBD podcast. Justin Nielsen here, your host, along with Arusha Piras, who joins me every week from O'Neill Global Advisors. He's a portfolio manager over there. And he also has that CMT designation, just like our special guest, David Keller. He is
at least 2 out of 3 here, Justin.
2 out of 3, right? Exactly. Well, tough crowd, you know. David, would you like to be my weekly partner here? There might be an opening soon.
Just throwing out some flyers, see if anyone else takes it. Okay. Yeah.
So we have David Keller with us, Chief Market Strategist at StockCharts.com. And I should also mention, David, I really like watching your final bar. We started taping this. We tape on Wednesdays. We started a little bit late to accommodate the fact that you have your final bar show, which I think is great. A lot of times you just do that on your own and you're just, chatting to the ether and having a great time. which
I don't have an Arusha to chat with. I'm sort of stuck on my own a lot of times. So that sounds great to me.
Yeah, well, you would be grateful though if you had an Arusha, right?
Yeah, we could all hope to have Arushas. Well, so let's get back to the this idea of the overbought. Because you and Arusha, again, both with your fancy CMTs, learned a lot about different indicators. RSI being one of them. That's the relative strength index. And so this is kind of one of those oscillators that people look at and often say, okay, what's happening with momentum? And tell us a little bit about what you're seeing on this QQQ chart that you provided.
Yeah, so I think in this environment, as we mentioned previously, I think a market like this is innocent until proven guilty, and what that means for me is you look for signs that things might rotate lower, right? So you look for signs that we're near an exhaustion point. I always tell people you look for signs that we're in like the 8th or 9th inning as opposed to the 2nd or 3rd inning of a bull market phase, to use a baseball analogy. So one of the great ways you can look for to identify or maybe anticipate a market top is when you start to see a proliferation of bearish momentum divergences. And what happens is when price is going higher, sort of a healthy bull market phase, you tend to have stronger momentum on the way up, right? And it makes sense because an indicator like RSI is just looking at what's the average up day, what's the average down day. And if the market's going up, the up days are probably a lot stronger than the down days. And so the indicator is improving. But a lot of times at the end of a bullish phase, you have the price continue to go higher, but the momentum actually starts to slope lower. And what that means is you're actually starting to have some down days along the way that are a little heavier and heavier, usually indicates some selling, a lot of times some institutional selling, sort of a technical way of sort of anticipating a bit of a change. You're seeing that right now with the QQQ. You're seeing that with the S&P 500. You're seeing that with some of the winning technology names like an IBM. You're seeing that pattern of higher highs on weaker RSI or weaker momentum. Now, I would say that this is really a leading indicator, right? This is one of those red flag types of charts. So on my checklist of things that tell me this was a market top, this is like one of the first ones. It says, okay, we might be nearing a market top because we're seeing similar conditions and momentum that we've seen at previous significant market tops. And if you think back to like the 2020 high, the 2007 high, these are classic market peaks where you had weaker momentum even as the prices were going higher. So it's not the end of the world type of pattern yet. And again, on a day like today, you see the S&P and the Qs moving up just fine, but it speaks to potential weakness underneath the hood. And that's what I think has me questioning sort of the dominance of the growth trade, the, I guess not as magnificent 7 sorts of charts as you're seeing Apple and others start to diverge. This sort of divergence speaks to that it might be weaker and less of a dominance than we've seen off of that October low up until now.
Yeah, so when you see a condition like this, or at least the way I generally interpret it is, you don't run for the hills at this point. You just kind of have it in the back of your head and saying, okay, it could be getting weaker. If you are in some of those stocks that started to sell off, you lighten up on those, maybe cut your losses. And a lot of times what happens also, David, I know you know it, and I know Justin knows this too, but your batting average will start to continue with this baseball. Your batting average is going to decrease, right? Where when you're at the beginning and starting in November and throughout the first few months here, batting average was probably like 80%. You're just hitting everything out of the park. But now it might be down to 50%. It might be 30%. You might be cutting more losses. And so it's those kind of subtle kind of things there that are telling you you might be getting out of the sync with the market. It might be you. It might be the market. But you're keeping this in mind, this divergence, but you don't want to kind of like because this is that lockout rally. It's been a lockout rally for the last 4 months. There were other signals out there saying, hey, you know what, it's getting too overheated and stuff like that. If you were too quick to get out, it's really hard to get back in, right? So it's that kind of that delicate balance.
And there is nothing worse, I think, as an investor than selling something up like 20, 30% and then leaving the next 200% and just sitting on the sidelines. Is there anything worse? And so you want to avoid that. So the way I think of it is, we used to print out way too many things, but we print out charts in my Fidelity days, and you had different piles. It was like the everything's great pile, just keep holding these. There was the clearly bad pile that I'm not going to touch. Then there was the question mark pile, like things that I'm actively watching. And I think something like a divergence is the kind of thing that would have me move it from the great pile to like the okay pile. And like, all right. And nowadays I would put it on a watch list. These are things, if I have a portfolio of 50 names and a couple of them start to show divergences, those go into my potential selling candidates to start monitoring them more closely and make sure that I have a good exit strategy in mind. And hopefully, honestly, I think at any point you want to have a good exit strategy, right? You want to be using trailing stops, whether it's a moving average or something to make sure that you're locking in gains and recognizing when things change. But the divergences just tell you starting to be an increasing likelihood or more and more likely that we're going to have some sort of pullback. So I just want to make sure I have a sense of what that might look like and what would I need to see on this chart to tell me to start to unwind some of that position. Where do I take 50% off? Where do I maybe, take all of it off? And I would say now is the time on charts showing that sort of pattern.
Yeah, definitely. It's kind of like that scenario analysis where you're saying, okay, this is something that could be down the road. I mean, look, if you're in a horror movie and you're like, gosh, there's a guy, he's down the road, he's got a chainsaw, he's pretty far away. Maybe I should tie my shoe.
Let's hide in the garage. Let's hide in the garage.
But there have been, and the way we look at it for those that have been, listening to IBD for a while and reading our stuff, we certainly pay attention to distribution days, right? Where you have those days where it's on heavier volume than the prior day, down more than 0.2%. And we have seen more of those days kind of clustering, but there are times where the market just doesn't care. We'll have those distribution days, for a while there, especially with the Fed, the quantitative easing, era where the TINA trade, there is no other alternative. You got to be in the market because where else are you going to get any return? It seemed like, you'd get distribution, maybe you'd go sideways, a blip, and then, you're right back. So are there times where you kind of say, look, the price is just too strong. I've got to ignore it. And the same way that you were talking about, like the overbought, it can get even more overbought. So are there times where you just kind of ignore it, or when do you kind of say, no, this is serious, I really need to pay attention?
It's funny. So I think the way that I like to approach it is, again, you think about, I always call it the primary trend. And I know I've read David Saito Chung and followed his, his market updates for years. I mean, what a fantastic, market practitioner. But he would always just reinforce sort of what sort of signals you're seeing. And for me, it's sort of take a step back. What is the trend? What's that primary trend? All right, now we start to look for signs that things are different. I think when a market's in such a significant uptrend that we've been in now off the October lows, it's not about the fact that we're going to make new highs, because that's probably going to happen, right? Pretty consistently. It's all about, do we undercut the previous swing low, right? You're really watching the lows on the way up. And as long as we pull back, which we're going to do, as long as we keep making higher lows, the chart's in a pretty good place. Where you want to be concerned is when we start pulling back and we stop making higher lows, right? When things start to really roll over. And that means you're seeing additional distribution. And I would say with sort of the O'Neill methodology, the distribution days would probably be part of that, right? Because you're pulling back enough and getting enough selling that it's sort of breaking a key level. I think those are similar ways of just showing we've seen broad accumulation and now something's different. So, and again, I think on most leading stocks, again, with some exceptions like a Tesla and others, most leading growth names, you've seen pretty consistent higher highs and higher lows. That's called Dow theory's uptrend. And I think you're seeing that in the S&P and the NASDAQ. So as long as that continues, as long as we keep having pullbacks, which we will, but as long as they keep pulling back to higher levels, we're still gaining ground on the upside. When we stop doing that, that's when I would get concerned.
Yeah, you're absolutely right.
What's interesting though too is that using the way IBD's analyzing the markets, Market School, right? Even Market School, which was pinned at the top level, that started to drop, right, Justin?
It did, but it was distribution related. And
Yeah.
to David's point, we really haven't had a confirmation of that distribution with the price level breakdowns. You know, we're still above the 21-day moving average line. The only signal that we got in addition to the distribution that kind of said something was funny with the price was on March 8th with the downside reversal, right? That was something like, oh, hey, watch out. You know, other than that, you haven't had any breaks of the 21-day. You haven't had any breaks of the 50-day. So yeah, you kind of have to have a little bit of both, right? It's you know, distribution without any price movement down in a significant way or trending down. It's you can't say the trend is over if, as David said, you're still making higher lows and higher highs. You know, it's just that's the definition of a trend.
I always joke. So my son Henry is 8 years old, and I always say, "What would Henry do if he's looking at this chart?" And I've done that. I've tested this recently. I show him a chart of a particular stock of the Nasdaq. I'm like, Henry, is this going up or down? And if Henry would say it's going up, then the trend is up, right? Don't think any more about it. And when that change, I'll let you know. I'll have the proprietary Henry indicator.
The new indicator.
I'll put it out on social media, but he's still thumbs up. Trend is going positive.
Yeah. Well, and you also mentioned, because again, so much attention was on the Magnificent Seven, but you started looking at Apple, and well, that wasn't looking so great. Tesla, okay, a little bit of a dumpster fire. Alphabet, until recently, was not looking great at all. So you had a number of these Magnificent Seven that were kind of showing cracks. Did that suggest to you at all, hey, maybe there's, and again, the market was still going up. So what was driving it? Is that why you're looking maybe at sector rotation now?
Well, yeah. So I think that's why rotation is so important. And here's a scenario that I think is becoming more and more likely in my head that I think we might see, right? The growth side, you start to see this with Apple and Tesla and maybe Alphabet coming off. Growth stocks have had such a run. So many other sectors have not really participated to the degree that you might expect. And, you know, areas like healthcare and industrials and materials and energy, some pockets of strength in there, but, you know, broadly speaking, those have not been the dominant sectors. But a lot of those that I just mentioned are actually looking quite strong here in the last couple of weeks, right? Energy all of a sudden popping higher as crude oil gets above $80 a barrel. Material stocks, steel companies, copper companies, all of a sudden starting to break out. And I would say that if you have that scenario where it's not really a risk off move, but more of just leadership rotation, if the growth sectors like a technology start to take a break, if industrials and materials start to work, the S&P and the NASDAQ are dominated by the growth stocks. So if those are struggling, the benchmarks are going to come down, even if stocks, quote unquote, are still fine, right? Even though breadth conditions are probably pretty good. And even though there are a lot of names, if you're scanning for stocks making new 3-month highs, you're not going to struggle to find them. They're just going to be in different sectors than we've expected. I think there's a whole generation of investors here that assume when the market's going up, it's growth stocks that lead the way higher, because that's what we've learned here in recent history. The three of us and others probably with a little more experience of previous cycles remember times when like financials were the top sector or industrials are leading the way. And I think your energy is sort of the top sector. And I think we might be in one of those rotational environments where, again, the benchmarks might look worse than a lot of those individual stocks would probably make you think.
Yeah. Yeah, it's funny because, you know, we've got the 40th anniversary of IBD coming up, and I was looking at the, you know, one of the original paper that came out, and there it's kind of like, why are we putting out a paper? This was back in 1984, and of course at the time it was like, yeah, we're going to be really focused on the New York Stock Exchange and the American Exchange, and to a lesser degree these over-the-counter stocks that you see some, you know, and,
others,
right? The others, right? It was this NASDAQ, you know, electronic thing that, you know, I guess we'll pay attention to every now and then. And, you know, now it seems like that's what everyone, you know, looks at. I mean, everyone still talks about the Dow, but you really look to the NASDAQ for where is your leadership gonna come from a lot of times. So what is this, you know, I guess if you're seeing the strength kind of go elsewhere and potentially the indexes maybe looking weak, even though some strength is still underneath, you know, what do you kind of use as your gauges there? Do you kind of go from that top down approach to the bottom up where you're just looking at the stocks and saying, hey, these stocks are looking fine, who cares what the index is saying?
I mean, I think there's a balance to it, right? I mean, I think, you know, and again, when people ask me, are you a top down or bottom up investor? I sort of say a little of both, right? Because I think part of what I'm trying to do is understand sort of the overall forest, right? You want to understand the big picture and the overall trends. But at the same time, one of the things I learned, and I vividly remember, I was just in New York last week and I walked past the old newsstand, which unfortunately is shuttered, where I used to buy the IBD every morning, take it to the office, pop it open. And I remember when I was just learning about stock picking at the beginning, no matter what the market was doing, this is like 2001, which was a horrible bearish phase, any of these periods, there were always stocks that are kind of working. There were charts that look pretty good, kind of those classic O'Neill setups, like they're in any market. And I've sort of translated that into the quote that I like to throw around is it's always a good time to own good stocks. And I would say that, in this environment, we pick a sector and I bet we could come up with some charts that look pretty constructive. And even in really defensive sectors like consumer staples, there are a couple names that actually look just fine, and utilities and REITs and, healthcare, and sectors that you probably don't think of as good in a particular environment. The charts in a lot of cases don't really care what you think should work. I mean, they're focusing on what's actually playing out. So I would say that, in general, I mean, I think I have a regular bottom-up discipline of just looking for charts that are starting to improve. Stocks making new 3-month highs, stocks making new 3-month relative highs, which I years ago would use Market Surge. At the previous edition of Market Surge, I would go through those on the ferry just for looking for stocks where the relative strength line was improving. And I think particularly in this environment, looking for stocks with improving relative strength versus the benchmark is really important, because that'll tell you if assets are starting to rotate in a meaningful way away from those growth stocks. I don't think you're seeing it a ton yet, but you are certainly seeing some improvement in value sectors, generally speaking, for sure.
Okay. Well, when we come back, we're going to take a look at some of the stocks that are on David's radar right now. So stay tuned. We'll be right back. Welcome back to Investing with IBD podcast. Justin Nielsen here, your host, along with Arusha Paris, joining me every week for now. If you can.
Wow.
Yes.
He's holding a grudge here.
Right. And of course, David Keller joining us as well. He is the chief market strategist from stockcharts.com. And he is a CMT as well as Arusha. But I'm outnumbered. But you know what? Maybe I will go to get my CMT just because I want to join all the parties. You were just in Dubai.
Well, you have to find people who sponsor you.
Okay.
And David and I, we have a lot of power. We could kind of block you out.
I don't know if you have a lot of friends in this podcast today. I don't know.
There's going to be this little black ball. I can see it now. So yeah, maybe I need to find another group to take me. So David, you've been talking a lot about sector rotation and moving outside of the Magnificent Seven. So what do you have on your list that you can kind of share with us?
Yeah, and again, what I love about the IBD methodology, and it's sort of, maps very closely to what I try to do. There's always names that are starting to work. And so I have a good, consistent process of looking for emerging strength. And I guess probably a consistent theme with the three stocks we'll talk about is that they're all starting to just break out of some sort of basing pattern of some sort. First one would be Duolingo. And again, I almost went like full value and talked about energy stocks and others, but this is just a chart that it just strikes me as a really compelling setup here. And it's really close to that breakout point, which I think is an interesting one. This is, a relatively recent IPO, sort of mid 2021. But what I love about it, you had that initial, big sell-off going to the, fall of 22, and then you started to see some consolidation around the lows. Then you start to see improvement. And I feel like one by one, this chart has gone from, weakness to strength, whether it's below moving averages to above them, whether it's underperforming the benchmark to outperforming. Earnings have improved. It's starting to show some stability there. And so, I like stocks that are making higher highs and higher lows. I think most recently you had that breakout in December. We sort of popped higher and drifted higher into the beginning of the year, pulled back to moving average support, and then rotating back to the upside. So as close to like a good cup and handle kind of pattern as I would probably look for. What's different about this, I'm usually not a big IPO person. I usually like to wait for a little more evidence that something is probably going to work. And I feel like what the chart is telling you, that Duolingo is really starting to rotate into a position of strength. I think really close to that breakout point, kind of getting above 250 or so would sort of clear the previous highs. I think that's compelling.
Yeah, and David, it's not only currently building a cup with handle on the weekly chart. I see just a big monstrous cup with handle.
Yeah.
That's spanning like a three years here too, right? So sometimes that's a positive too when you have those kind of fractals working in your favor, where you kind of see a cup with a handle within a cup with a handle.
Completely. And what's interesting, again, this recent set up sort of a nice pullback. And in general, I mean, I think what's great about names like this is it's giving you some opportunities maybe to layer in on the way up. And I think most recently the bounce off of the recent swing low is encouraging. And now again, a breakout above the previous high, I think, is a really compelling setup.
Mm-hmm. Now, you mentioned how this was an IPO back in 2021, where I mean, that was one of the year of the IPO, or I guess maybe the year of the SPAC, probably more appropriately, the special purpose acquisition companies that seemed like they were, happening left and right. Yeah. But, let's talk a little bit maybe about the fundamental side, because we've got some big moves that we've had, earnings related, and you can kind of see if you look at the left-hand side with the earnings, 2023, we've gone from losses, so negative earnings per share, to now we've gone to profits, so positive on the earnings per share side, to estimates that are really quite large in comparison. So yeah. You do see this reflected on the earnings line, one of the new features that we just added to Market Surge when we made that transition. So is this kind of a factor for you? I mean, it's estimates, so you can't necessarily say, oh, I'm going to hang my hat on it, because a lot can change. And by the way, I should mention, I do have a position in this. I should mention
as do I.
Yeah. So, and I'll be honest.
We
give you the freedom to choose what you want, but and more importantly, I have a 508-day streak on Duolingo.
So it is actually still continuing.
Wow.
I thought you paused for a while.
No, well, you know what? Every now and then I have to use it. It's called a streak freeze. So sometimes I don't get around to it, but yeah, I have had to use. It's basically, if you don't do it for a day, you have a way to kind of freeze your.
It's like a cheat day on your.
Yeah, exactly. That's exactly what it is. So, but yeah, so talk a little bit about the fundamental side, because I mean, they have been talking about. Not to get back to the AI theme that everyone's talking about, but they have talked about how they're using AI and these other technology things to kind of make it easier for their company.
I think you hit on a couple of things. I think the way that, I mean, this is sort of the ideal IPO setup, probably not losing that much ground in the first year, but if you look at the trajectory in earnings, this is sort of a nice success story about where expectations are really have really improved. And now you're starting to see, the market kind of matching those expectations, or the, company actually fulfilling those expectations. And the reason why the price is going up, and I think when you're analyzing a chart technically, you can either ignore the earnings and just follow the price. The price tells you everything you need to know. Remember, the price is going up, which tells you there's optimism about future earnings potential. But I think looking at the relationship is really powerful. The green line that you have on Market Surge now is awesome, because as a longtime user of the institutional O'Neill products, that was one of my favorite parts of it, was looking at that relationship between price and earnings. Because if you look over the long term, stocks tend to trade to their fundamental valuations. And so this is a great way of illustrating that price earnings relationship. I think that the trend is clearly positive. So good technical setup, but starting to see an improvement in the earnings expectations going forward. I think that's a real good overall picture for the stock.
Yeah, and not only the price, David, it's the volume. You just have these massive, and Bill O'Neill, I remember hearing it years ago, skyscrapers coming in. And so that those are those large institutions, one of the ones that David used to work for, and they're not acquiring 100 or 1,000 shares, right? They have to acquire a lot of shares, so it takes some time. But when you start seeing those kind of massive kind of moves like that, someone's building a position here. So that's another thing in its favor.
Mm-hmm. One other thing I will say that I kind of brought this up a few weeks ago when I was doing a stock market day. It was funny. I was doing it on Leap Day, and I was manning the charts, and I kept on going back to 2009, and of course there was no Leap Day on 2009. So Market Surge was like basically saying, no, you can't do that. But if you could go to 2009, actually change it to Baidu first. Change it to Baidu first, because you have this look on Duolingo where you came up so strongly.
All the base.
Yeah. And then, I remember Bill telling me, like, a lot of times you have to have some type of pause, and so you see that in Baidu in 2007, where it had that a big, strong move. And it just kind of reminded me of that. Bill had a number of examples of this. Baidu is one that came to mind. If you look at Booking, Booking had kind of a similar thing. And if you want to go way back, 1967, Redmond Industries also kind of had this look. So do you ever kind of, you worked at Fidelity, you were in that chart room. How much do you kind of look at historical precedents and, and hey, this reminds me of this stock?
For sure. I mean, as much as possible. I think I was taught, charts are your history lesson for the markets, right? If you want to think about how now compares to some other period in history, whether it's an individual name or the broad market conditions, you can think about macro inputs like interest rates and inflation and Fed policy and everything, or you can just look at the charts because charts have a lot of similarities. I mean, the way I would answer that, Justin, is, the technical toolkit that we are taught and that we learn, the things that you keep going back to, you use them because they've worked consistently. And I was often asked at Fidelity, why do you use certain indicators or certain charts? And the answer was, we've used these charts to manage money and we've made money with them. So we keep using those things. The things that we don't make money with, we stop using those. And so, I'm not back testing it. The back test is, here's what the fund is doing because we're picking things that are working. And again, I think, William O'Neill was one of the best at just looking back at historical charts. I have the Brunswick chart here as my mouse pad. I have that in front of me as a constant reminder of, it's nothing's necessarily new, right? There we go. I mean, there are consistent patterns that have worked. And the fact that, you can go back to a couple IPOs that look a lot like Duolingo, I don't think that's a coincidence. I think that is just the fact that market cycles tend to rhyme. And I would say that's because human nature is very consistent. And we have a lot of new technology in the different market structures, but we're still people making good and often poor decisions with our capital.
Yeah, absolutely. Let's go ahead and take a look at a stock that I haven't looked at in quite a while. You were going to bring up Dow, a chemicals company, not the Dow Jones, the owner of IBD, but the Dow Chemical.
Dow Chemicals, and I would say, it's very easy, and I almost went full growthy types of things that I just thought would be interesting names, but I really wanted to look sort of outside, something that you probably had not looked at. And neither of you mentioned you hold this at the moment, so I guess that tells you something too.
I really haven't seen Dow exactly.
But no, I think Dow for me is just it's representative of a whole group of names, and you guys said too, right? You haven't looked at this in a while. I don't think a lot of people have either. And I'm starting to get drawn to areas of the market that I have not been looking at enough, things that have not been coming up on my radar, things that I don't think of as consistent uptrends. I think of a chart like Dow Chemical as more of a laggard or more of an underperforming name, because that's what you think of as materials. They don't really move the needle. But if you look, it's actually starting to improve, and you're actually making a nice rotation above moving average resistance. And we're back above some upward sloping moving averages, starting to make higher highs and higher lows. I think something like this, the things that I would generally look for are, do you see a rotation from sort of a bearish trend to bullish trend? I think we're starting to see that. The things that I would want to see would be improvements in relative strength, right? So in general, these kind of names are still underperforming because those growth leadership names are doing so well. I think if that scenario we talked about in a previous segment plays out, charts like this all of a sudden become the juice. These are the ones that start to rally. And again, I think there's a whole generation of investors that don't think of Dow as a good offensive play, but it might be one of those underappreciated areas to think about.
Mm-hmm. Yeah, I mean, to your point, the relative strength is definitely one of those things. It's hard to get excited about a stock that can't outperform the S&P 500, because then you're like, well, why do I take the single stock risk? I'll just buy the S&P 500 and let that go. Now, if the indexes do start kind of coming under pressure, but there's individual stocks, then I guess the other question is, how do you make sure that you're picking those that are the outperformers? Because sometimes it's tough when you're seeing your stock. Maybe it's not going down, maybe it's going up. It's just not going up as fast as everything else, and it makes you feel like I'm in the wrong lane.
It's true. And that's why I think relative strength out of anything you're going to look at is probably the most important thing, because that tells you, it's really less about what do I think about this chart, but am I looking at the right chart in the first place, right? Am I even looking at the right area? And I think improving relative strength is one of those important signs that tells you there's some momentum behind this and that you're getting something additional to just having exposure to the market. This particular name was a bunch of, along with a number of other names, I scan regularly for stocks making new 3-month highs. So there's two ways to think about scanning for stock ideas, in my opinion, right? You go very specific. I'm looking for this very specific set of circumstances, and I get like 5 or 10 names that are like my unicorn perfect setups. I'm not a fan of that. I like to have a broad stroke. I look for 3-month highs, and then I put them all in a list and I start flipping through the charts. And I've done that for years with different platforms. Used to do it again with Market Smith, and we do with Market Surge, just flipping through chart by chart. These are the names that are just starting to work. And then you start to think about relative strength. You start to look at earnings trajectories, start to look at volume and say, all right, out of these names that are starting to work in some way, which are the ones that are really actionable that I want to get to? And that's where you start identifying some buy points and things like that. So Dow, to its credit, making a new 3-month high. But again, if you look at the longer term chart, it's still more sideways. And I think getting above that base, probably above 60, would take us to a new swing high above that sort of early 2023 high. That could be an interesting completion of a rotation higher. So sort of on my watch list of potential breakouts here.
Yeah, and so a couple of things here. Well, first, I think this shows the importance of charts because it enables you to go through a lot of stocks in a short amount of time and figure out which ones are best for you. So a lot of times, this has come across the radar where for me, a lot of times it's just next, because it's just going sideways. It's just not the type of stock that I'm looking for. So I think that's one thing that really just helps you stay on top of the market because you can really focus on the ones that are good setups for you. And then really the second thing is understanding other members in the industry group and seeing how they're doing. And I think there's a big positive here, David, for the Dow. They do have an industry member here who has a ticker symbol CMT. So I think that's another positive for this.
Even the stocks are against me. So okay. So we're going to move on to another stock with before we find other stock ticker symbols that can make me upset and doubt myself. Let's take a look at Airbnb because for a guy that says he doesn't look too much at the recent IPOs. Here's another recent IPO, 2020.
I was going to say 2 out of 3, right? I guess I'll have to change my intro on that one. They just came up though, right? And so, it's funny. I think Airbnb for me, it's represented this whole travel tourism. I mean, there are a number of charts we could talk about. Cruise lines, Royal Caribbean, and others are bouncing higher. That would be one direction to go. And others, but I think this one, hotels, of course, have been strong. But I think Airbnb in particular, again, I think this shows this nice rotation in a lot of ways, a lot like the Duolingo chart, where you've seen this rotation from downtrend to uptrend by whatever way you want to define that. Whether you're drawing like trend lines off of the highs that all of a sudden are broken as we break higher, the moving averages all sloping downwards. Now they're all sloping upwards. The fact that we're breaking above resistance, which is what's most important to me here in the last month or two, kind of really getting above those previous swing highs. I think of this as sort of probably call it an inverted head and shoulders continuation pattern, I guess would be the long-winded way of describing that. But I just tend to think of it as a basing pattern, right? It's a sideways move and now something's different. And this is one of those charts when I scan for stocks making new 3-month highs. And Arusha, to your point, I'm flipping through it and you're skipping the Dow. This one comes up and I'm like, whoa, hold on. And I jot that figure down. Like this is one of those layup ones because you're seeing all these signs of improvement. And also on this one, you're starting to see an improvement in relative strength as well. And I think that's where, if a Dow starts to look more like this, that's where I would get a little more excited about it. But I think this is one actionable wise, pretty close and not too extended after breaking above resistance. I think it's an interesting actionable point here.
Mm-hmm. Yeah, and to your point, one of the things I like to look at is on the technical side, the relative strength rating, to kind of see, okay, what direction is it going, and it certainly has been kind of in the 80s here for a while. It's at 82 right now. 1 week ago was 85. 4 weeks ago was 83. So it's right there in the 80s, and that's kind of nice. So now it's a matter of, can it get that extra oomph? We didn't talk about it with Dow, but what about the earnings on this? So you're in that, you're in the profit area. Some decent numbers. I mean, these aren't 1 cent EPS numbers here. Not a very steep earnings line, but it is going in the right direction. does that, is there any kind of qualification you have in terms of the fundamentals and that improvement?
I mean, not necessarily. I mean, I would say with a name like this, you don't see any like red flags. You don't see any real
Right.
negative signs at the moment, right? I mean, it's sort of it's a slow and steady gainer. The earnings are not blowout impressive, but they're certainly not bad, and they're in line with what you're seeing with the price action. I mean, as much as we've seen a short-term improvement, this isn't like an SMCI kind of going vertical, right?
Yeah.
It's sort of early stages. So and again, what I've always recognized is the charts, the technicals tend to lead the fundamentals, right? The charts tell you expectations are improving. A lot of times the earnings will reflect the reality a little further on, because that's when the dreams kind of come a reality. So I think at this point, it's more the expectations that things improve from here. That's what gives you confidence as a long-term holding, as you see an improvement of earnings beyond what we've seen so far. But I just don't see anything that would dissuade me from this as a good technical opportunity here.
Mm-hmm.
What about like sponsorship, David? Do you ever look at anything like that? Like I pulled out the right-hand side panel here, and your old friends at Fidelity Contrafund is building a position in this stock, and they might be one of the ones who are just slowly accumulating it, or have been accumulated over the last few quarters here. Do you ever take a look at that?
Completely. And I would say what you have to remember, and again, I'm glad I'm not in a position anymore where you would be taking action that you would literally see it reflected on the chart as you're doing things.
Right.
That is not a comfortable place to be, I think, mentally, but that's true. And stocks like this go up a couple percent because of a lot of reasons. They go up meaningful amounts over time, and the volume registers big institutions taking some accumulation. In two ways, I think you can validate that. One is you have the mutual fund data, and you can actually see funds are accumulating it. The other thing, and this is arguably the best tell, is just looking at the price and volume relationship, right? The price moving meaningfully higher, the volume significant. All of us with all of our retirement accounts don't move the needle on volume, but big institutions accumulating meaningful positions that take days and weeks to actually accumulate. That's what pushes the volume up. So I think in both cases, it's pretty encouraging here.
Yeah, the old elephant in the bathtub that Bill O'Neill used to refer to. You certainly don't have to wait until the 13F filing to see. Oh yeah, they're splashing around in there.
That's right. That's right.
And look, if you're doing your travel on that travel theme, if you go to another country, get an Airbnb there. Hopefully, your Duolingo will help you, get around in whatever country you go to.
But don't bring any chemicals.
Fits into that narrative. But if I had planned this better, that could have been a whole little.
No, but you don't mix those chemicals. You might not be able to get on your flight if you bring.
Yeah. That's Well, see, that's why we skipped it. So, because we know better. So, hey, David, it was a pleasure having you on as always. Thank you so much. And where can people follow you, get more information? I mean, you have your final bar. That's something that they can just watch on YouTube. Anywhere else that they should be checking out for you?
No, I appreciate it, guys. Good to see you, Arusha and Justin. You guys are awesome, and people should know how much fun it is to do this show with you guys. You guys laugh a lot, and it's a pleasure. Stock Charts TV. I host a show, the Closing Bell Show, every day called The Final Bar, and then my site's called MarketMisbehavior.com, where I try to help people just get out of their own way and make better decisions. So look forward to people engaging me in either of those places.
Yeah. Awesome. Well, thanks again for coming on again. Pleasure to see you.
Cheers, you guys.
Okay, take care. That's going to wrap it up for us this episode. Tune in next week because it's going to be a little bit of we time, except no we. It's going to be Scott St. Clair taking my place as I go visit my daughter at the University of Hawaii. We're doing spring break Hawaii this year. So do tune in for that because Scott St. Clair always has a lot to say. And Arusha is the perfect foil to say it with. So that's going to do it for us this week. Thanks a lot for watching. We'll see you next time.